Hello everyone, this is Dan Hussey with RJO Futures, bringing you our daily market recap for some of our major U.S. futures. I want to begin the day starting with the bonds, specifically the 10-year note here, as the interest rate was hiked today by the FOMC March meeting. They decided to raise this basis point, or the interest rates 1 basis point, which caused a what effectively was a rally in the bonds, which was a little counterintuitive. We also saw a rally in the S&P, rally in stock and equity indices, rally actually in just about every market here today, as a U.S. dollar selling seemed to be the buy the rumor, sell the news event, as it's generally accepted that interest rate hike and interest rates rising is positive for the U.S. dollar. So seeing a little bit of an adverse move here coming out of this news could just mean that the markets hit some kind of short-term sentiment. It was a buy the rumor, sell the news fact, and at this point, bonds are being bid, the S&P indices are being bid, gold's being bid, and the U.S. dollar is selling off. So with that being said, let's begin with the 10-year note here, seeing the bond market rally back inside of a range that we generally have been in from that 125 handle down to the 122s. This, to me, constitutes kind of a no trend, no trade zone. I utilize a method that determines when this type of chop is highest, has a high probability of occurring, and we're just, kind of in that range, so to speak, as we speak. Now, that doesn't mean we couldn't get some kind of short-term top before a move down in the bonds. And in the 10-year note here into this 124 handle, but a more likely scenario is that we're in the midst of a larger correction higher, and bonds could actually break out of their range. And I would say to the upside, we'd look for the 10-year to potentially trade and get some wind here under its sails, and trade maybe all the way up to that 126 area. 126s are kind of a cluster of prior support that held back in last March, so about a year ago. There was a support level at this point that we broke through, and it would simply be a retest of that now broken support as resistance here if we get a move up into that 126 to 127 area. The full 50% retracement here off of the prior highs does come in all the way up at 126, so there's a lot of room to the upside from a technical perspective for this market to rally. And if today's profit taking was enough to spook some of the bears in the bonds, some bond bears, out of the market, we could see that short covering take us up to a test of some highs. And of course, this is reflective of interest rates dropping here as bonds rally, but which is not, the dovishness we've seen out of the Fed. I just think that there may be a short-term market sentiment here that got overdone to one side. Clearly, there's profit taking after this news, and we've seen a short covering rally enter the 10-year. With that being said, the Japanese yen, which tracks the 10-year closely, you can see here 2 4-hour charts. It's almost identical price action to the 10-year. And actually having them up side by side, you can see one of the strongest correlations in the futures market, which exists, which is between the bonds and the yen. And that's pretty much because of a carry trade that has existed for the past 30 years. And how highly correlated these two markets are with each other is a direct reflection of exchange rates and interest rate differentials between Japan and the United States. So saw some sideways price action in the bonds. Could be seeing a rally up to test at least the high end of the range, maybe even a break higher for a larger three-wave correction. And then the yen could have found a support level here that could do the same, test up to a much larger and a better selling opportunity up into that 92 handle. So again, I'm looking for maybe that rally to ensue here. There is the potential to buy support or buy this market on a pullback against these potential lows here. And just like there's the potential to sell this market against these prior highs, there's some very key and defined levels in both bonds and the yen to utilize for stops. And, the moral of the story is that, this is a range until it fails here between the 90 and the 86 handles in the yen and the 125 and 123 handles in the bonds. So we'll see how those two markets play out in tandem here but generally looking for a little bit weaker U.S. dollar in the near term, the yen to appreciate in value and bonds to potentially rally. This could all, help support the S&P 500. If bonds are going down generally, that is positive for the S&P. But the S&P needs a bit of a pullback into better support here, down into this 2345 to 2340 area, at least a retest of those lows into 2350. I'd imagine. I want to see a nice healthy three-wave pullback, broken resistance, tested as support here with a trend line against highs, and a continuation level that could then take us up towards the 2400 area for the E-mini S&P futures. So that pullback here in the S&P, better support, not necessarily a selling opportunity here, because this market could very much be inside of a range caused from its highs to the lows we've had, because it is very choppy so far. This was just straight up on a news event. We didn't hold any type of fib, for a short or for sellers to identify and potentially hold as resistance. And the lack of that type of price action, and what this price action might be indicative of, is that we had a nice pullback, a correction against that pullback, and we'll get one more leg down in a larger corrective structure. So keep an eye on that for the S&P here. May be supported as low as the 2340s here in the near term. That kind of brings us into some of the currencies. Let's talk about the euro real quick. The euro's got a bit of a life in it, and in the short term here, as we dial down, you can see that it held a full 50% pullback into the 106.57 area here in the that's June for the front month there, but a pullback basically from February lows to March highs here, held 50%. And then now we're going through March highs, which is pretty indicative that March so far is an up month, and may to try for the next 2 weeks to rally higher and close higher still. So be important to go back and look where February highs. Well, February, prior highs here into February started the month up into the 108.90s. So March started basically at its lows for the month, down at the 105.50s. It's rallying. Next logical area of major resistance for the euro is up into the 108.90s. If it gets through there, there may not, there isn't going to be much stopping it until a couple key technical areas. There's a confluence of both fibs and trend lines here at the 111 handle. I like resistance up into that area. I'd like to see a nice three-wave move, see resistance hold, and that could take us down for another test down to 102s. There is trend line support that held on the euro here for multi-year trend line from lows to lows. That broken support now being tested as resistance. If you continue that trend line on, comes in right here at this 111 area, and then of course there's trend line resistance that held and that generally kept the market sideways between 107.30 to 119, 120 area. Then compressed a little bit between 107.30s and 117.90s, and then compressed a little still, and then finally in October actually started to break down lower out of that what was basically a range. Right now, testing the low end of that range as resistance up into this 110 to 111 area is pretty indicative of a corrective structure. We'd be looking for a top potentially to form there that could then take trend and test, then support. That's a game of testing support, and that could take you all the way down into new lows. So this sell-off in the U.S. dollar seems to have gotten some legs today. And I believe is starting to put in a pretty constructive sell-off in what could be the final leg of a larger correction for the dollar, as really highlighted here by the euro in this kind of three-wave move up off of the current 2017 lows at the start of the year of a 104.20. It's interesting that the lows of the year were right at the start of the year, and so far we've rallied. This is all part of basically a bull trend for the euro futures that has started and might continue, through the first quarter and into the second quarter, as we've seen. The British pound, also very sideways market. I want to bring up some key historic levels. This 135 handle, until Brexit, the pound had remained basically above 135 since the 80s. It actually bounced between like 140 to 135, and 165-ish to $2 for a long time, for multi-decades. It broke through it with Brexit, And now it's just a series of kind of cascading lower and dead cat bounces. It's testing broken support areas as resistance. It's holding full 50% Fibonacci retracements. And I've got two areas of resistance here I'm looking for in the pound. One, well, there's definitely more aggressive resistance that you can look for on this rally off of lows. But, I think it's tough to buy into these without a solid level to put your stop. And at least with the low end of this range, whoops, if we can get it there, below a 120 now on the pound, very likely would signal for lower. So if we stay above 120 on the pound, I anticipate a test back up to 125, 126 area, where there could be resistance just from the most recent range and kind of compression that the market might be showing through trend lines here. And if we get through that area, I'd say a test of 130 handle would be pretty nice. As there's definitely a resistance levels at 50% lines up there, as well as this cluster of prior lows that held just post-Brexit. The immediate support we found was down into 134 to 130, and that 400 pip range chopped around. It sat on that 130 handle, then went through. Now it's coming back up to test 130 as resistance, see who's there, and then head lower from there is ultimately the kind of the game plan I'm looking for. So. Generally, I prefer trying to look for resistance as this trending market does seem to be heading lower. But some of these, many of these swing trades or these, I wouldn't call them necessarily trades, but kind of swing ideas definitely have some form of, some time element here that some patience might be needed. In the short term, things like the euro, they could produce long opportunities as we're seeing, constructive price action in the bounces, but we're still very much in ranges, and ranges can be difficult. All right, on to some of our commodities. Let's start with crude. Crude is very range bound. Getting resistance up to the 54 to 55 area was completely expected, as that was the area the market held as support on the way down. When it first tested and broke through 60, could then break back above, and then finally fell to test at 40 in the high 30s. Now testing that as resistance once, found support. Tested resistance twice, found support. Tested resistance again, right back down into support. This 47 to 45 area is supportive. We could easily test down to 145 still, so be very careful with crude. It's still, it hasn't rallied enough, in my opinion, to constitute, the low end of this range being in, and maybe looking for the market to retest the prior highs up to the 155, but that's generally been the trade since February of 2016. It's been sideways between 57s and 47s, and there's better ways of capturing this market than trying to trade it directionally. There's option strategies you can employ that utilize markets that are between certain strikes. In this case, the 57 to 60 area and the 45 to 40 area look very interesting for strangles and option strategies that look for markets to stay inside the range with maybe a straddle, a long straddle on outsides to in case the market does break one way or the other. You could have some cheap out of the money options to take advantage of a break of either one of those kind of areas as well. So everything in trading is about risk reward. And some opportunities aren't necessarily just directionally based. Sometimes the opportunity is a little more hidden. So let's move on to corn and beans. Or actually, let's do crude gold, and then we'll come back to those. So gold generally traded from its December lows to the most recent highs in February, all the way up into a full 50% retracement of its prior decline from July through December. That 50% level came in at the 1260s, came up, kissed that 50%, and has now turned sharply lower. Granted, it did hold this 1195-96 area, which was the 50% long from December's lows to the highs after. So you basically have a long and a short, both presenting opportunities, or sellers and buyers from two technical levels that might put this market keep this market between 1260 and 1200 in more range-bound price action until it finally breaks. I do see the potential for what I would refer to as like a head and shoulders pattern, with the head here being at 1260, a right shoulder forming, or left shoulder, kind of maybe a pitcher's head, or somebody, I don't know what you call this, but it's skewed with the neckline. You can see trend line support here for neckline, and then a parallel line here for the right shoulder line. Brings up in a confluence of fibs with the full 50% retracement from 1260 to the 1196 lows, comes in right at the 1230 area. So looking for resistance now in gold up into the 1230 to 1240 area for potentially continuation lower, and downside targets if we break lower could take you to 1060. And then upside targets if it breaks higher, back up to test 1400 and the high end of this range, as we'd very likely be breaking above trendline resistance then, and the market could be due for a much more sustained rally. So lines in the sand being tested here for the metals markets. Definitely a short-term pop here in profit taking. But was today's news, was it enough to change the fundamental picture of a stronger dollar, interest rates going up, and what does that mean for gold? Typically that means a lower price of gold, but inflation is of course the kicker here, that if inflation really starts to set in, you could see commodity prices actually rally alongside the US dollar, and actually, well, that could get dangerous because then you might be thinking about hyperinflation. Anyway, point being is that correlations are great until they fail, and then they disappear for a while, and then they usually come back, but they're not always great for trading. Sometimes they're just good for looking at and being pretty. Corn and beans, basically pretty simple price structure scenarios here. Beans has been showing basically a propped up market. I don't want to call it the market's manipulated or anything, but there was clear support down into the $10 to $9.50 area for beans here on the last kind of sell-off from June or July of last year through September, October, November, where it eventually bottomed out. We got a bit of a dead cat bounce and certainly what looks like a corrective rally off that area. The market couldn't break above the 1100 area, sold off of the 1190 or 1092, full 50% short of that full 50% or that range or the resistance area. So definitely gave some technical reason. Gave a strong technical reason for turning from that area. But the fundamental picture for beans has been very consistent this year. There has been plenty of beans, more that have ever really been produced, and we've got a lot of them left over. So that leaves a very high stock to usage ratio. And what that ratio basically tells you is in one number. The stock to usage ratio tells you a snapshot of the supply and demand, the global supply and demand, or even national supply and demand for any commodity. In this case, grains, which are stored year to year as farmers try to market and get the best price possible throughout the year. They're often stored right till times when there might be lack of supply, prices rise, and they can sell the beans that they were sitting on. But of course, that gives you price exposure. So the futures were developed to hedge that, right? And in this case, beans have via one tool I look at for all commodities is the futures curve. I have two futures curves up, and all this is basically plotting each serial month on a chart of their real-time kind of quote. And in this case, on the left you have soybeans. On the right you have corn. There's something very distinctly different about these two markets. Well, the first is corn. You got this nice steep curve going from the lower left to the top right. That's what we call contago, or what is called a normal market price condition. In other words, when markets are well supplied, this curve forms. So you get this straight kind of line going off in a 45-degree angle or up into the sky. And the idea is that every month, every contract, and I have highlighted kind of your big two, the July and decent corn and July and Nove and beans. Every subsequent contract that goes out into the future should be pricing in the cost of carry and the cost to store this grain, which in this case you can see how the market's priced it in. The cost of storage between July and December is effectively 24, or I'm sorry, for corn is like 12 under or something like that, 12 cents, and you can see the difference in these two prices is right around that area. Or I'm sorry, it's like 20 cents, and the difference between July's price for corn at 3.73 and the D's price of corn at 3.86 is about 13.5 cents or something. That 13 cents represents the cost of carrying corn. So the market is saying no, you're not getting all of your carrying costs, which is 20 cents, but you're getting a lot of it. And when there's a well-supplied market, this is how the futures curve typically looks. Now, beans is the other way. It's inverted. Its front months are above its back months. Inversions typically occur where there's a supply crunch and there's not enough of a commodity to meet demand, and market participants, out of fear, try to buy up as many beans as they can, which affects your front month futures more so than the back months, because those front months are what are going to get gobbled up as they represent the beans that are currently here in existence and floating around in the economy. With that being said, it doesn't make sense that the futures curve is telling you a bullish price scenario, which is an inverted market or backwardization, which would suggest beans should go higher, but the fundamental picture doesn't show that. So there's an inversion in the futures curve. We're seeing the price of July drop faster than the price of November, and you're seeing this market basically return to this type of look. So you're going to look for these back months to go up relative to the front months in beans, and watching that curve kind of shift back into shape will be show will on an outright beans chart will very likely be the result of of your old crop bean prices dropping pretty dramatically as the market seeks to recover its carrying costs. So that was a little more in depth than I think it needed to be, but generally speaking, broken support now on the beans as resistance up into the 1025 area, 1024. Could offer resistance. There's always the full 50% retracement of this prior rally. That comes up around the 1040 area. So I'm looking at and expecting beans to probably stay below the 1050 to 1060 area and continue basically melting lower, and maybe even get a price, a test of those prior lows down at 1065, and downside targets, could take you as low as the $9 handle. So we'll see what happens. See if they want to test their lows, really fall off, and see how how much this market might will want to adjust here based off of the current price scenario we have in the futures, which suggests a very well supplied market. Corn on the other hand, a little bit less of a sell-off and a little more supported in this pullback. We see broken support, broken resistance being tested as support here. We also see a supportive trend line still holding, and a full 50% long or 50% area into this 360 area in the front month corn. A rally up to test $4 in corn I would consider the market quote unquote buying acres, trying to improve the price of corn relative to the price of soybeans to encourage farmers to plant more corn rather than beans. By buying more acres, it can adjust that macroeconomic trend we see, which is there's a lot of beans. Sure, there's a lot of corn too, but relatively speaking, there's a lot more beans relative to what we've seen historically in stock-to-usage ratios than there is in corn right now. And then wheat's a whole other beast. We're not going to talk about that today because I wanted to keep this video a little shorter than it's been. But wheat is even more well supplied and has more ample global supply. But as the number one food source for the world, having too much wheat isn't necessarily a bad thing, but definitely makes it tough for wheat producers and recuperating some of their costs. So we're going to continue to watch and look for these seasonal trends in both the beans and the corn, which is effectively the bear spread corns, bull spread beans, from what we've seen in that futures curve as it's adjusting back to a normal market for beans. With where the corn market is, you can actually get a pretty a lower risk, lower margin requirement type setup or trade going bull spreading corn than just trying to outright buy the futures and catch a falling knife. So there is some advantages to taking spreads here rather than the outrights for what are generally directional trades, but are more attached to that fundamental dynamic and the carry trade involved in those commodities. So with that being said, have a great day, everybody. We'll be back with you as price action develops here, and we'll see you all in the morning. Take care and have a great day.